When we think about the idea of investors and how they're thinking about what's going on right now, really, investors are focused on all the uncertainty out there. And what we try to do is create a situation where we reduce uncertainty for the human beings we're working with, Dom. And we want to make sure that they have in their minds the things that are in their control rather than what's out of their control.
All right, so what exactly is then in control and out of control right now? Because it seems as though there are so many things that investors cannot deal with on their own, mainly trade, tariff policy, everything else that's happening. So what exactly can you do in that kind of environment?
So what you can do in that environment is really think about what you're trying to accomplish with your money, Dom. And the key here is what risk is actually required for you to reach your goals, what you're trying to accomplish, and what ability do you have to take that risk, given that we don't know exactly what's going to go on with the Fed. We don't know exactly what's going to go on with the trade wars. There's not a lot of certainty out there. So what ability do you have to take risk to get to where you want to go?
Well, so let's talk about that risk factor.
Sure.
I mean, we know the conventional wisdom, age, younger, you can take more risk, older, you kind of ratchet it back a bit. But in this kind of environment where you're dealing with the Fed, we don't know about interest rates, we don't know about trade policy, all of those things, how exactly do you advise clients then on what kinds of risks are appropriate to take in this situation?
So we talk about three types of risks. And the key risks, though, hang on to your time horizon. So how long can you actually expose yourself to market risk? And Dom, if you have really just a short time horizon, and we all know market timing can be pretty risky, it's probably not a good idea to really expose yourself to risk during a period like this if you don't have a lot of time to expose yourself to markets. The other two are really around your spending, how much do you need to consume of that money, and then the third one is how important is it to you?
All right, so Michael, I mean, Goldman Sachs is out. They're economists. They say that they have a note this weekend. They are skeptical, they say, of the Fed using interest rate cuts as insurance against a possible U.S. slowdown due to trade tensions. Goldman writing, quote, "We think the hurdle for such cuts is likely to be higher than widely believed." If that is the case, do you agree with them? Or is the market maybe a little bit off on the way it's pricing what the Fed will do with regard to interest rates by the time this year is over?
So I'm a behavioral scientist, Dom, and what I would do is encourage people not to focus on what the markets may or may not do in reaction to what the Fed may or may not do. This is a very dangerous approach with respect to your own financial life. So those people who are investing their own capital, trying to achieve basically outcomes with their own wealth, it's really critical for them to focus on what the time horizons are that they're focused on, what dollar amounts they need for their own goals, and ultimately how important that is to achieve it. So if the goals aren't that important, then making predictions possibly on what the Fed may or may not do and when, that might be something to look at. But if the goals need to be accomplished, really taking a look elsewhere is probably pretty important.
10 seconds.
Yep.
What's the opportunity that you are most focused on in the markets right now?
Right now, we're really focused on this idea of broad asset allocation, exposing yourself to a lot of different risk assets so that you don't try to market time and take risks that are inappropriate for your goals.